Good morning, everybody, and welcome to the fourth of our Pensions Dashboards webinars, the fourth and final Pensions Dashboards webinars, following the publication of our consultation on the 31st of January. My name is Simon Bonniwell. I am the Deputy Director in Private Pensions at the Department for Work and Pensions, who oversees dashboards policy. And as I said, today's webinar concludes our series following the publication of our consultation. They've been very valuable for us. I'm sure this last one will be as well. I hope that they have been for you as well. This is not kind of the end of all of our engagement, obviously. We're really looking forward to having lots of responses to the consultation itself and kind of continuing engagement after that as well. This particular session, this final session, is on value information to be displayed on dashboards. A kind of very critical question which has come up in a number of our previous webinars, and we're going to go into a bit more of a deep dive into that today. It's a vital consumer user need, and I'm expecting lots of discussion. We'll do some quick domestics and then get going. So first of all, so you're aware, we are recording the session with this, so you can watch or listen to it again at your leisure. It will be put onto the Pension Dashboard Programme website. The approach we will take, the structure will be the same as the other webinars. So we will start off by running through some slides, giving you some detailed information. We have presenters for DWP as usual, have Amy Owens and James Holland, but I'm also very happy to welcome colleagues from the Financial Reporting Council, Nessa Leung and Simon Vassman, who have just launched a consultation on the ASTM1 assumptions, which underpin statutory money purchase illustrations, which is an important part of the proposals that we've got in this area. Following the presentation, there will then be a Q&A session with our expert panel, which consists of those presenters, but also representatives from the Pensions Dashboard Programme and the Pensions Regulator. As with the recording, the slides will be published on the Dashboard Programme's website, so look at those afterwards as well. What we'd like is, whilst we're going through that presentation, please do put questions in the chat in the sidebar. We're unable to kind of have a hands up and put you on camera and ask the question directly to the panel approach. It would be a bit too complicated. We've got too many people. So please use the sidebar in the chat. We'll collect the questions and then try and sort them into some sort of sensible order and then put them to the panel after the presentation. We'll try and get through as many questions as possible. We are still developing our frequently asked questions product, so we'll pick up ones which we don't manage to cover and try and answer them through that as well. So again, that will be on the Pensions Dashboard Programme's website. I think those are the main things for me. Before we get into the meat of it, I wanted to just quickly reiterate that although this consultation and this webinar are kind of specifically about the regulations which DWP is responsible for, it's only one element of the overall project that's being overseen by the Pension Dashboard Programme. And I'm very grateful to have Richard James, who's the director of that programme, with us today. And he's going to say a few words just to put this session in the context of the wider programme. Richard, over to you.
Yeah, thank you, Sam. Good morning, everybody. Pleasure to be here. Great to be here for the fourth and final webinar. The first three have been incredibly useful to us, so I'm really looking forward to getting a lot out of this one as well. And of course, this is one of the most important topics that we are dealing with anywhere in this consultation. We all know that. We've been doing an awful lot of thinking within the Pensions Dashboards Programme about how to present retirement values. We know that this is the absolute heart and beating soul of the pensions dashboards, and so getting this right is crucial to delivering on that objective for the dashboards of equipping people to really understand their retirement provision and make better decisions on the back of it. So an awful lot of work and thought has gone into the proposals that you are going to hear outlined to you in this session. And that work has involved quite a number of things. It's involved policy thinking, but it's also involved a good degree of user testing within the programme, where we have experimented with a range of different ways of presenting retirement value information to users to see what makes sense to them and to see what helps them to contextualise that and to make good decisions. And the proposals that you are going to hear outlined to you today reflect what we have learned in that user research so far. So an awful lot of testing, thinking, and research gone into that approach. We're keen, obviously, to learn about a whole raft of things from you. The approach you're going to hear described is going to underpin the design standards that will set out how every commercial dashboard and the MAPS non-commercial dashboard need to present this information. So we are keen to hear your thoughts on how we make sure that is right and equips people to make the best possible decisions, and how we need to present and caveat some of that information to make sure that people understand the basis on which it is presented. We're also really conscious that getting this, this data in the right shape and ready to be presented into dashboards is one of the biggest challenges that you in industry will face in getting ready for dashboards. So we're keen to hear thoughts on what that means for you as well. That's probably about all I wanted to say on that. Let's get into the meat of it. Really looking forward to hearing your thoughts on all of this. Thank you all for making the time to come and talk to us about it. Simon, back to you.
Thanks, Richard. Right, let's kick off. As Richard says, I'm going to hand over to Amy Owens, one of our policy leads at DWP, to kick off the presentation. Amy.
Great, thank you very much, Simon. So this final session in our series of webinars, as you know, on our consultation, is a deep dive into value data for the pensions dashboards. And we'll also cover, as Simon said, the interaction between DWP's consultation on the pensions dashboards and the FRC's consultation on the methodology behind some of the calculations that will appear on the dashboards. And as Simon mentioned, there'll be time for Q&A at the end of the session, where our panel, including DWP, FRC, TPR, and PDP, will be answering your questions. And please feel free to use the chat function during the presentation today, and we'll answer as many as we can. And any of those that we can't answer today will be included in our Q&A that will be published on the PDP's website. So take a look at that once that's circulated. So we'll start the session today by giving a brief overview of the consultation, as we know that not everyone will have this context. However, we won't be able to go into the detail of the other elements of the consultation aside from values today. So if you would like to know more about any of the other elements of our consultation, you can watch the recordings of the previous sessions that we ran. And these include sessions on an overview of the consultation, delivering and using pensions dashboards, and finally, the pensions industry getting ready for dashboards. So moving on to the purpose of dashboards. So pensions dashboards will be secure online platforms for individuals to access information about their pensions, including their state pension, in one place at a time of their choosing. In line with our key policy objectives, pensions dashboards with the unique Pension Finder service will help individuals to navigate and keep track of their pensions, reconnect people with any lost pension pots, improve awareness and understanding, and help individuals to effectively plan for their retirement. Individuals will have the choice to use the dashboard service provided by the Money and Pension Service or Qualifying Pensions Dashboard Service, which may be hosted by different organisations, including, for example, one the individual is already familiar with, such as a known pension provider or their bank. So I'll now move on to the purpose, scope, and timeline of the regulations. This consultation is fundamentally about seeking views on the proposed regulations, which are designed to support the introduction of pensions dashboards. The regulations set out requirements to be met by organisations wishing to provide pensions dashboards in order to become qualifying pensions dashboard services, which is set out in Part 2 of the regulations. Requirements on trustees or managers of relevant occupational pension schemes in terms of connecting to the digital architecture and the data they must provide, set out in Part 3 of the regulations, and provisions for the pensions regulator to take enforcement action in relation to pension schemes that do not comply with their requirements, set out in Part 4 of the regulations. This set of regulations would only apply to occupational pension schemes with at least 100 members, although we expect to regulate for smaller schemes in the future. A relevant member includes both active and deferred members of a pension scheme. We are not including pensioner members in this initial set of regulations, which means that pensioner member information will not be shown via dashboards, and these members will not be included when determining a scheme's size. If a member is already taking benefits from a pension or a portion of it, we think that they are likely to be better engaged and aware of what their pension is worth. Our priority for initial dashboards is to provide information on pensions while still in the accumulation phase. The FCA is consulting separately on rules for personal and stakeholder pension schemes. The FCA's consultation, which covers broadly comparable requirements for personal and stakeholder pension schemes, was launched earlier this month. Except where otherwise stated, the remainder of this webinar discusses proposals that apply across both DWP and FCA consultations. In terms of the timeline, interested parties have until the 13th of March to respond to this DWP consultation, and then we intend to publish our response this summer, before the parliamentary recess. Subject to parliamentary timetabling, we hope the regulations could then be laid and approved later this year. The FCA's consultation closes on the 8th of April, which allows time for affected parties to respond to both consultations. The FCA will aim to finalise its rules alongside or shortly after the regulations are approved. The FRC have also launched a consultation on their guidance on ASTM1, methodology which will be used for the values that dashboards will display, which closes on the 6th of May. We will be hearing more about this from the FRC later on in this session. So I'll now recap how our proposals ensure consumer protection. We hope that dashboards will increase engagement with and understanding of pensions, and that this increased awareness will lead to better decision-making and more informed choices being taken. Pensions are often the biggest financial investment individuals will make throughout their life, so it's essential that we take data security, presentation, and consumer protection seriously. In delivering the many benefits of bringing together information about people's pensions on dashboards, we know there are also potential risks, such as susceptibility to scams or mis-selling, or the potential for individuals to make decisions without all the necessary information. We will be seeking to mitigate these risks through our various consumer protection measures. Consumer protection, and this includes both prevention of harm and redress if things do go wrong, is a shared responsibility in which the DWP, the Pensions Dashboard Programme, pension providers and dashboard providers, regulators and ombudsmen all have a stake. Security of information is of fundamental importance, and PDP is responsible for the delivery of the central digital architecture that will make dashboards possible, as well as the design of the ecosystem and the standards governing the ecosystem. The design ensures that security of personal information within the ecosystem is paramount. A key principle of consumer protection for dashboards is that consumers are in full control of who can access their data. Individuals using a dashboard will be asked to provide consent for the dashboard providers to process their personal data in order to search for their pensions. The regulations contain provisions around consent and who can access an individual's data. Access to the data should be available only to individuals unless specific consent for delegated access is given. Qualifying dashboard operators should not be allowed to access data for any purpose, and only temporary storage of the data for display purposes is permitted. The individual has the right to withdraw their consent at any time. The dashboard provider should tell them how to do this. It should be easy, and the dashboard provider should act on requests as soon as possible. So we have also considered what consumer protection measures might be needed in regards to value data specifically. For instance, data manipulation will not be permitted other than those prescribed by design standards. Those design standards will detail the circumstances where data may be combined, displayed graphically, or displayed in alternative to annual amounts. The design standards will be developed through testing over time. And the dashboards will not have the function to allow transactions, such as consolidating pension pots or transferring pensions. Furthermore, the dashboards will include caveats about the values presented, that they are estimates, not guarantees, and we advise taking professional advice before making any financial decisions. We will also explain what we mean by certain values. for instance, the meaning of projections or illustrations. We would welcome responses to our consultation to consider whether these measures are sufficient. So before we go into the detailed proposals, for context, we wanted to recap what's emerging from the user research and testing. Since it was established, the Pensions Dashboard Programme has sought to understand the existing evidence base on pensions dashboards and to expand it, filling evidence gaps and understanding user needs. As we found through research as part of our original consultation, the programme's assessment of the existing evidence highlighted there is a high-level user need in respect of pensions dashboards, which is that individuals wish to know what pensions they have and also how much money they'll potentially have when they retire, so they can effectively plan for retirement. The qualitative research that has since followed, carried out on behalf of the programme, found that if a dashboard did not offer up value information, so essentially a find-only dashboard, it would have a very limited appeal. And the user testing to date also indicates to us that providing both accrued and projected values alongside each other helps the individual's comprehension of each. In other words, an accrued value on its own might be difficult to understand, but providing a projected value gives it context so it's more easily understood. The programme leads a usability working group, which includes consumer group representatives, and is there to help that user interests are ensure that user interests are firmly embedded in the ongoing development of dashboards. As I've touched upon, the programme is carrying out user testing already, and this will expand significantly as the programme's testing phase evolves and enters into private beta. It's important that dashboards land successfully and are credible to users from day one. Our proposals are designed to put the interests of users first, while balancing that with any challenges and concerns presented by different parts of the industry. So I'll now hand over to James to speak about the value data proposals.
Okay, thanks, Amy. So I'm going to give a very brief introduction to data as a whole on this slide before moving on to talk about value data in more detail. There are two types of data on dashboards. That's find data and view data. Find data is personal data, which is provided by the individual to the digital architecture and sent to schemes by the Pension Finder service, which allows trustees or managers to search their records for a match. If a match is successfully found, trustees or managers will return the scheme data relevant for that individual. Information relating to an individual's identity is used for the purpose of matching and locating pensions records only. Trustees and managers will not have to use particular find data elements for matching, but they will need to decide which data to use to search their records and find savers benefits. So view data is the collective term which describes administrative, signpost and value data. It is data which is returned to the dashboard by pension schemes once the individual's identity has been verified and a view request has been made, either by the individual or their delegate. Administrative data is split into three categories. The first is information on the pension scheme. This must be provided by all schemes to which the regulations apply and gives details about the pension scheme, things like the name of the pension scheme, a description of the nature of the benefit, whether the individual is an active or deferred member, the date the individual became a member of the scheme, and the individual's normal pension age. The second category of administrative data is information about the scheme's administrator to enable the individual to get in touch should they want or need to. The third category of administrative data is information about the employment that gave rise to the pension. So that's the name of the employer and the dates of employment. This data is provided by schemes only if it is available and if they hold it routinely anyway. In the consultation, we have proposed that administrative data should be returned to the dashboard users immediately, with allowances where an individual is a very new member. So moving on to signpost data. This consists of a website address that is provided to individuals where they can access, if applicable, information on member-borne costs and charges, the scheme's statement of investment principles, and the scheme's implementation statement. The FCA is proposing a signpost to the annual report in the Independent Governance Committee or Governance Advisory Arrangement, as this is the nearest comparable equivalent to a statement of investment principles for certain personal pension schemes. We propose that signpost data should be returned immediately after a request is received. So finally, value data. This consists of accrued and projected pensions data, which I'll explain in more detail in the next slide. Okay, this is the data that dashboard users are likely to be most interested in, and which will be the most useful in terms of understanding the value of their pension. We propose a comprehensive suite of value data requirements in order to provide individuals with as much useful information about their pension as possible, and to make dashboards the most effective they can be. Researchers highlighted that users expect to see the information on projected value amounts in particular, and that seeing this information is likely to increase engagement and help them to understand the value of their pension better. However, our engagement with industry has highlighted the challenges that some schemes will face in providing some of these values, and we're keen to strike the right balance between delivering an ambitious and successful dashboard service for individuals, whilst acknowledging the demands placed on schemes. We hope to use this consultation to gather views and better understand the challenges that parts of the industry may face in providing these values, as well as further understanding user requirements. In most cases, the requirements we have proposed broadly mirror those already in place for statements, so follow the requirements set out in disclosure regulations, but we highlight areas where we've proposed to deviate or go further. In proposing this suite of value requirements and the methodology to be used to provide them, we have sought to deliver a set of values which have a degree of comparability both within and between scheme types, so that when dashboard users are presented with their values, they are able to some extent to interpret them similarly alongside each other and to build up a picture of what their income might be in retirement. We'd like to receive views on the extent to which this has been achieved in these proposals. I'll provide a very brief overview of the requirements across all schemes now and go into more detail in later slides. For money purchase benefits, we'd like schemes to provide an accrued pot value, an annualised accrued value, that's the pot value expressed as an annual income. If held, we'd also like a projected pot value, and finally, an annualised projected value. For non-money purchase benefits, the requirements differ for active and deferred members. For active members, we'd like both accrued and projected values, and for deferred members, we'd like an accrued value to the illustration date. For cash balance benefits, there are again different requirements for active and deferred members. For active members, we would like accrued and projected values, each to be provided in pot and annualised formats. And for deferred members, we'd like to see just accrued values, again in both pot and annualised formats. For collective money purchase schemes, or CDCs, we follow the requirements set out in the proposed updated disclosure regulations. So for active members, that is an annualised value for both accrued and projected, and for deferred members, just the annualised projected value. I'll say a little bit more later about the approach on hybrids. We propose that schemes may provide values from a statement produced in the last 12 months, or from a calculation made in the last 12 months, giving the option of providing more up-to-date values, but recognising that some may prefer to provide statement values. And I'll come back to the expected return times for value data further down this presentation. I now want to go through each scheme type in a little more detail to set out our proposals on methodology. And I'll start with money purchase schemes. So as Amy noted in her introduction, our approach to the calculation of these values is to refer to ASTM1, which is owned by the FRC. They'll be setting out some of their approach in more detail later in this presentation. And we've taken this approach to link to ASTM1 mainly to maintain parity with the pensions illustrations on statements. But we recognise that there are potential alternatives to this, and we're keen to on your feedback here. For money purchase schemes then, I've already set out our proposed high-level requirements. Members should receive accrued values expressed as both lump sum and an annualised amount, and a projected annualised value plus a projected lump sum if held. And I'll take each value in turn to provide some more detail. So the accrued pot value is the value of the members' benefits built up so far expressed as a lump sum. This value is already routinely provided to money purchase scheme members as part of their annual benefit statements. We're proposing an annualised accrued value, which is the value of the members' benefits built up so far expressed as an annual income. We recognise that this is a new requirement for money purchase schemes and are keen to hear feedback on its utility, its deliverability, and also on the methodology we're proposing. We believe that the annualised accrued value will help individuals to contextualise and better understand the amount of pension they have accrued in a scheme by seeing it as an income as well as a single pot value. And we think it'll be helpful and comprehensible, a helpful and comprehensible value when presented against any state pension and non-money purchase entitlements. Our proposed approach to calculating this value is to take the value of the accrued pot and apply the methodology set out in ASTM1 to deliver an annualised value. We're proposing that when applying the ASTM1 methodology, the elements which concern future growth and also fund growth are omitted. I recognise that there may be some interest in including fund growth in this calculation, so we're interested in views on this in the consultation responses. So effectively, adopting the approach to ASTM1, which is being consulted on by the FRC, the annualised amount is simply the pot value with an annuity rate applied, presented as if the member has reached their normal pension age. Our view is that this provides a reasonable comparison point, for example, to accrued non-money purchase values. So moving on to projections. These again follow the requirements set out in ASTM1 and will be familiar values, although the specific methodology to be adopted will reflect the outcome of the FRC's consultation. The projected pot value is an estimate of the value of the member's pension benefits expressed as a lump sum at the individual's normal pension age, which is to be calculated using the methodology set out in ASTM1, which we'll cover later on. As I mentioned, this value is only required if held on the basis that it is not a current requirement for pensions illustrations, but we do think it's a helpful value to be able to provide on dashboards to show a more complete picture. And given that the current annualised value, which is required, must be based on this pot value, it would not seem a huge step to provide it. Well, obviously, we're keen to hear views on that. The annualised projected value is an estimate of the value of a member's pension benefits expressed as an annual income at the individual's normal pension age. The projection would incorporate the current value along with any future contributions and anticipated investment returns using methodology set out in ASTM1 before applying an annuity rate. The FRC are consulting on an approach which removes the option to include lump sums, meaning that dashboards will show a consistent approach across different schemes. There are a number of exemptions that relate to money purchase schemes only, which, if they apply to a member, will mean that schemes are not required to provide projection information to them. Schemes may choose to provide projections anyway, in cases where exemptions apply, which they are permitted to do by the regulations. The exemptions do not extend to accrued pensions data, so members will still receive information about the amount of pension they have built up so far as relevant to the schemes they are in. So the two exemptions are, firstly, where a member is within 2 years of retirement, and secondly, where the accrued value of an individual's pension is less than £5,000, where no contributions have been made since the previous illustration date, and where the trustees or managers of the scheme have previously given notice to the member that information will not be given to the member again unless further contributions have been made. These exemptions aren't new and are in line with those set out in disclosure regulations. So that's money purchase schemes for the moment. We'll return to ASTM1 again shortly, but I'll move on now to non-money purchase schemes. So for non-money purchase schemes, our approach is again broadly in line with existing requirements, and in this case under disclosure regulations. But we're keen to understand whether the approach we've taken to drafting these regulations provides the right basis for schemes to calculate the values in the way that they would expect to, but at the same time limits the extent of variance across different schemes. We do need consistency to ensure that people can read across different values on dashboards. So for active members, we'd like an accrued value, which is the value of the member's benefits built up so far. The calculation should reflect the amount payable if pensionable service were to end at the illustration date, presented as if the individual has reached normal pension age. It should be calculated in accordance with the scheme rules and assume no increases in salary. We'd also like a projected value, which should again be calculated following scheme rules, assuming that the member continues in pensionable service and continues to build up benefits until normal pension age. And again, should assume no increase in the individual's salary. It should be presented as if the individual has reached normal pension age. In both cases, and for the deferred value, which I'll come on to, values will most likely be expressed as an annual income, but the draft regulations do provide the potential for this to be expressed as a fixed lump sum if that's the likely outcome of a particular scheme. And it should be clear that we don't mean here a lump sum commuted from income. That's an outcome direct from the scheme. The data standards will enable dashboards to present the values appropriately. For deferred members of non-money purchase schemes, trustees or managers will be required to provide an accrued value only. This is the deferred pension valued to the illustration date in accordance with scheme rules. So as drafted, we think it needs to include statutory revaluations on any non-guaranteed minimum pension. A couple of points on deferred DB. First, we recognise that the approach we are suggesting is not entirely consistent with the way in which the 2003 disclosure regulations are set out. Disclosure requires a value which is the amount of a member's benefits payable from the date benefits are payable, so arguably is a projected value. We also recognise that there are different interpretations of this in practice, including for some schemes providing values from the time of leaving without any revaluation. So we think the approach we've taken is one which reflects common practice where such values are provided, but we're keen to hear views. We also know that there are alternatives to the scheme rules calculation we have proposed, including a simplified approach, which we've described in the consultation document. And again, we're keen to receive views on this. So I'll now cover cash balance schemes and CDCs. On cash balance schemes, we're proposing that active members should receive accrued and projected values in both pot value and annualised formats. The accrued pot value should be calculated in the same way as the accrued value from non-money purchase schemes, in essence, the amount the individual would get at retirement if they stopped contributing at the illustration date, calculated according to scheme rules without any earnings increases. This would be presented as a lump sum rather than as an annualised value. And the annualised accrued value would then be calculated based on that pot value using the assumptions in ASTM1 minus the elements regarding future contributions and growth. The projected pot value would again reflect the methodology for a projected non-money purchase calculation, so is the amount an individual might get if they were to continue accruing up to their retirement date, with the calculation based on scheme rules, assuming no increases in earnings and presented as a lump sum. And the annualised projected value would be calculated using the relevant assumptions in ASTM1, again applied to the projected pot value. For deferred members of cash balance schemes, we're only expecting accrued information. The accrued pot value would be valued to the illustration date in the same way as the deferred non-money purchase valuation. And the annualised accrued value would be calculated in the same way as for active members by applying the relevant ASTM1 methodology. So finally, I'll cover collective money purchase schemes or CDCs. The value data requirements we're proposing from CDC schemes reflect those that are contained within the amended disclosure regulations for collective money purchase schemes as brought forward by the DWP's 2022 CDC regulations. We propose that active members of CDC schemes would receive an annualised accrued value on dashboards as well as an annualised projected value. Following the amended disclosure regulations, this would be for the annualised accrued value, an illustration of the amount of pension which may be payable to the member at their retirement date if pensionable service were to end on the illustration date, having regard to the latest actuarial modelling under the scheme. And for the annualised projection, we'd like an illustration of the amount of pension which may be payable to the member at their retirement date if contributions continue, again having regard to the latest actuarial modelling under the scheme. We propose that deferred members of CDC schemes would receive a projected annualised value on dashboards, and again, the methodology would echo that contained in the amended disclosure regulations for those schemes. So I'd like to conclude this session on values by covering hybrids, public service pensions, and the state pension. Our proposal on hybrid schemes is that they will be subject to the same value data requirements as other occupational pension schemes. If an individual has two or more separate benefits, the scheme should provide separate returns to dashboards. Our expectation is that where one benefit is calculated with reference to both money purchase and non-money purchase formulas, that only the greater value should be provided. We know that there is some considerable complexity in hybrid schemes and schemes with hybrid benefits, and are seeking views in the consultation as to whether our policy approach is the right one. For public service pension schemes, the requirements mirror those for other non-money purchase schemes, but we've proposed additional provisions to reflect the McLeod remedy and deferred choice underpin. Data standards published by MAPS would ensure that, if necessary, more than one value for the same entitlement can be displayed. And finally, state pension values will also be provided by the Department for Work and Pensions. These will be the estimated state pension amount that the individual may get at their state pension age based on their current national insurance record, and a forecast of their state pension at state pension age, which is essentially a projected amount. So that concludes our section on values, and I'll pass on to the FRC, to Vanessa, who is going to present some more detail on their approach to ASTM1.
Thank you, James. So the pension disclosure regulations specify that statutory illustrations on money purchase pensions must be calculated by reference to ASTM1. Given the mandatory nature of the regulations, although this is referred to as guidance, in regulatory speak, this is set as a standard, which is the S in ASTM1. The FRC takes its responsibility to maintain ASTM1 seriously. Although in recent years, we've not made any changes to the methodologies or the assumptions, we have still undertaken a substantial amount of work to justify that decision. In developing ASTM1, we follow the FRC's principles for the development of codes, standards, and guidance. And that include being convinced that a change is necessary to address a clearly defined issue and that the benefits outweigh the costs. The emergence of the pension dashboard promises to change the way people view pensions. And instead of receiving information about their pensions one at a time at the moment, they will have the ability to view them all together in a way that allows them and encourages comparison. And because of this, change is necessary. The FRC aims to publish the revised ASTM1 by October 2022, but with an extended lead time so that the standards come into force only from October 2023, when the estimated retirement income will start to be shown on the dashboard. As we will cover in the next couple of slides, the main changes are intended to improve the consistency and comparability between different providers' illustrations. And this has necessitated removing some flexibilities that has been present in ASTM1 until now. And because the dashboards will display values using ASTM1, the values that people see on their annual statements will also be the values that they see when they log into the dashboard. We will, of course, continue to review ASTM1 annually, as we have always done. A key objective is to maintain a stable set of parameters when we do the review. However, there may be occasions where conditions forces us to make changes. And in these circumstances, our aim would be to limit the changes to the parameters and preserve the approach and methods. So as it's been mentioned previously, the DWP's consultation runs from the 31st of January to the 13th of March. The FRC's consultation runs from the 14th of February until the 6th of May. So there is a 4 weeks overlap with the DWP's 6 weeks consultation period. We deliberately ensured crossover between the two consultations so that respondents can consider the proposals in totality. The changes proposed in ASTM1 are more substantial than it has been for a long time. And so we are very keen to hear views from schemes and other interested parties about the proposals, the deliverability of these values, as well as the potential impact of these proposals on individuals. So let me just highlight the key changes. So firstly, substantial changes to the methodology used to provide the fund growth assumptions or the accumulation rate assumptions to improve consistency across the schemes. And secondly, to removal of the existing choice around elements of the projection calculation methodology, again, to improve consistency. Given the large scale of the change, there has been extensive engagement with our stakeholders. In 2021, DWP invited the Joint Forum on Actuarial Regulation to convene a task force to look into this. This joint forum aims to foster collaboration, and the members of this joint forum includes the regulators who oversee financial systems in which actuaries play a part. So naturally, it includes FRC and also includes PRA, TPR, FCA, and IFOA. The task force itself was led by the FRC and included a wider set of participants, for example, industry representatives, academics, and independent experts. And the aim of this task force was to produce a set of technical standards which can be used to produce consistent ERI illustrations designed to provide consistency between different providers and across different pension types. Towards the back end of last summer, the task force set out its advice to the Minister for Pensions and Financial Inclusion. And this included both the recommendations for the technical standards and the alternative viewpoints identified by some members of the task force. The proposed changes in ASTM1 in the FRC's consultation take into account the recommendations from the task force and FRC's subsequent research and refinement of the proposed methodology. We also then engaged with the providers to further inform our proposals, which Simon is going to cover in a minute. So without further ado, I'll hand over to Simon to talk about the proposed changes in more detail.
Thank you, Vanessa, and apologies, I was just having trouble getting off mute. As you can see, this slide provides a bit more of the specifics on the major changes, as you may already have picked up from reading the ASTM1 consultation paper, if you have. First of all, let me deal with the fund growth or the accumulation rate. Now, till now, we've taken the view that providers understand the specifics of their funds better than we do. So we've allowed, and still do at the moment, the providers to choose the most appropriate accumulation rates for projecting DC funds. However, the annual survey of rates actually used for illustration shows a wide range for each asset type. Now, this means that individuals looking at the estimated retirement income and the pots will be seeing side by side on the dashboard illustrations based on different rates of growth. These differences may reflect real underlying differences in the funds, or they may reflect differences in the degree of optimism about the future that the different providers have. The individual will find it difficult to know what to make of such information, even if they're aware that this is happening. So, consistency has been mentioned before, and we feel there's a need to ensure that for a specific fund, any two providers would illustrate the same ERI figures. We considered a number of approaches. There is a school of thought that says we should have used a single rate for every single fund because the projection and illustration is just that, it's not reality. But we also recognize that there's a link between voluntarily accepted risk and anticipated return. And so after doing in-depth cutting-edge research, we framed our proposals to recognize this. Now, as you can see on the slide, we're proposing to prescribe the accumulation rate based on the fund's volatility. We started by seeing whether we could place funds into groupings in the same way as the EU have done for UCITS, that's for non-pensions pooled funds. This would have meant 7 groups. Our research, which covered over 1,000 UK pooled funds, with many of them having data going back to 1990, showed that we could have a sensible risk-return relationship by reducing this to 4 buckets. There are particular technical reasons why we were able to do this. We examined putting funds into the buckets by looking at the volatility of their price movements over the preceding 5 years to the particular date we measured, and then tracked that investment performance over the following 5, 10, and 20-year periods. So we did this going right throughout the history, going back to 1990 for those funds where we could do. We found that over longer time periods, the relationship between a fund being in a particular volatility group and the subsequent returns was pretty strong. Deliberately, we've chosen a very simple method of measuring volatility and risk, and we've minimized the number of groups and tried to find a balance in the frequency of measurement so that we don't leave it so long that there could be secular change coming in. However, conversely, it's not so often, that it becomes a significant burden for industry and providers to actually do the remeasurements, the calculations. We opted for annual remeasurements, and the annual is typically the cycle with SMPIs as well. This helps to reduce the complexity to industry, and it also helps to maintain the stability of the groups. And what we also did is we introduced a corridor so that small temporary changes in the group into which the fund should be placed could be ignored. And this is also another way of helping maintain the stability. Throughout, we've tried to balance giving reasonable, consistent information to savers without overburdening providers. Now, the other big change that I want to pick out is the process of decumulation at retirement. And this, as you see, appears in a number of the boxes on the slide. We've had to look for ways to show a standardized approach based on the income in the year of retirement. So we selected annuitization based on a level single life annuity. We recognize that this is not uncontroversial, and we do want your input on whether this is the right approach. People will not be able to understand whether an income is level or increasing based solely on the figure for the year of retirement. And we have a concern that they may not read notes sufficiently closely to be able to distinguish on their dashboard which pensions are of which sort. We do want your views on whether we've made the right choice by selecting no pension commencement lump sum, no tax-free lump sum as well, and also a single life annuity without any increases. As regards the discount rate for annuitization, we're keeping the same approach as currently and previously has been the case in AST1. Although we have clarified that the rate should be based on the gilt yield of level gilt rather than as previously where annuities could be chosen either to be level or increasing, and the base assumption was based on index-linked gilt yield with an addition to allow for a level annuity. We're also aware that since pensions freedoms, there's been a trend towards drawdown rather than annuitization. However, we felt it was too early to take a long-term view on this, although it's definitely something that we will keep in view, and it may well be something that we have to come back to at a later stage. Now, finally, even though an annual statement is not required within 2 years of retirement, we understand that there is an expectation that a significant number of people within this age category will be looking to use the dashboard to find out what they can expect at retirement. As such, we recognise that we needed to do something that goes beyond the 2013 disclosure regulations. And the approach we've taken is to recognise the current annuity rates becoming very important as close to retirement. And therefore, we've tried to mirror the FCA approach in this regard. And very lastly, you will have noticed that on the mortality side, again, we're keeping our approach the same as it was before. We're using the central estimates coming out from the CMI. We've just taken the opportunity to upgrade the table, to modernise the table from the previous one, the 08 tables, to the 16 tables. If we move on now to the next slide, we're going to look here at the sources of input that went into the proposals in our consultation. Firstly, as Vanessa's already mentioned, the JFAR task force. After extensive discussions, it produced a report which was submitted to DWP and to the Minister. But given the wide range of stakeholders, each with their own needs, perspectives, not all of which were compatible, it's unsurprising that there were minority views as well as the main recommendations. But in general, we reached a point at which the participants in the task force could stand behind the combined content of the report, even though the recommendations may not have been the first choice for each of them. It would have been impossible to reach complete harmony with such a diverse team. And I think a great deal of thanks must go to the members of the task force for the work that they put in. We were also kept aware of the PDP user research, and this was invaluable in helping us to anticipate how individuals may well understand and use the dashboard illustration information that they see. As I've mentioned, for the fund accumulation, we carried out cutting-edge research. With the help of an academic, into the actual risk-return relationships observed in UK pooled pension funds. Now, this is the first time that these funds have been analysed in this way, and the results provided valuable insight and confirmed the relationship that we thought should exist in theory. Once we firmed up with our thoughts, and during the process, we also had meetings, informal meetings with a number of key providers and stakeholders to check from their perspective whether the proposals that we were making were sensible. These meetings generally verified what we believed, that although we were asking industry to carry out systems work to set up the new approach, and there would be cost, we acknowledge, in that, no or very small cost increases, or maybe even reductions in cost, are likely to emerge in the subsequent years. Now, there was a particular concern about whether providers would have 5 years worth of data, which is what's needed in order to be able to calculate the volatilities. And we identified 3 situations that require further consideration. The first was new funds that have not been around for 5 years, where there may not be a history, well, there won't be a history going back for a 5-year period. The second relates to SIPs, where the provider doesn't hold a history, performance perhaps, or they may hold non-standard assets within the SIP. And lastly, in general, it's unquoted assets, or even pooled funds that contain significant proportions of unquoted assets, for example, some property funds. Now, in the consultation paper, we've acknowledged these, and we have made proposals for these situations. And we very much are looking for your views on whether you think the proposals we've made are optimal or not, or whether you have other ideas. We really do want your input on this and on other matters. So, having said all that, I'd now like to hand back to James to continue.
Thank you, Simon. Okay. So I want to touch on the implication of the FRC consultation on the expectations for the return of values which use ASTM1. So in recognition of the fact that the new ASTM1 methodology will not come into force until October 2023, so this provides a longer lead time for industry to make preparations for these more significant changes, it won't become mandatory for schemes to provide values which use ASTM1 to dashboards until a statement has been produced after October 2023. So effectively, as SMPIs roll through in the 12 months from October 2023, dashboard values should follow. Schemes may provide values before that time, and they must reflect the correct methodology at the time of illustration. So I'm going to finish this by covering the proposed return time requirements for data. Pensions dashboards are a digital service, and we want our approach to response times to be ambitious. We want to create a service that is user-centric, and we've put individuals at the heart of our proposals. We recognise, though, that there's a balance to be struck between user needs and industry deliverability, and we're keen to understand from the consultation whether our proposals strike the right balance. Before getting into the detail and response times, it is helpful, I think, to set out some overarching thinking. It's very much our view that the response times proposed in these regulations are a starting point. We want to be ambitious, and in time, we're keen for these proposed timings to be reduced to help improve the quality of the service provided by the pensions dashboards. For money purchase schemes in particular, we'd like to move towards instantaneous responses for all requests in the future. And with this in mind, we want pension schemes to consider now how they can put in place mechanisms to facilitate the provision of data to dashboards as quickly as possible. We've outlined in the slides the proposed maximum response times for administrative and value data. The draft regulations do not prevent the return of data more quickly than this, and where that's possible, it should be delivered. So on administrative data, we believe that for all schemes, administrative data should be returned immediately after a review request is received. This is important because we believe that at the point at which an individual is seeking their access to their pension information on the dashboard, they should be made aware immediately of what pensions they have. Our approach to the return of value data is one that we believe strikes the right balance between ensuring up-to-date information is provided to individuals, whilst also ensuring that it's deliverable for schemes. So we recognise that some schemes will be able to respond more quickly if they're able to provide a value from a calculation that's already being carried out. Where that is the case, we propose that value data returned to an individual should be from a value that has been generated for a benefit statement within the last 12 months, or for another purpose, but using the same methodology within the last 12 months. If such a value has already been generated, the expectation on the trustees and managers of all pension schemes is that the data will be returned immediately. The implication of this is that we expect schemes to store calculations made in a format that is in accordance with the data standards and which is ready to be returned immediately. There are some exceptions to this. We propose in our draft regulations that where a relevant value has not been calculated or provided for a benefit statement within the last 12 months, that all pension schemes will have up to 3 days to return value data, except for non-money purchase schemes, which will have up to 10 days. This recognises the fact that some non-money purchase schemes have additional challenges in terms of the availability of data. Schemes which offer hybrid benefits, that's where the benefit is calculated with reference to both money purchase and non-money purchase formulas, will also have up to 10 days. So that concludes the presentation, and I'll hand back over to Simon.
Thank you, James, and thank you everybody for presenting. We'll now move on to the question and answer session. We have had a lot of questions, some of them quite detailed, which I suspect in certain cases might be better dealt with a written response, but we will go through as many of them as we can in the kind of half hour or so that we have left, and we'll put them to the panel, which, as you can see from this slide, consists of a series of dashboard policy leads from Department for Work and Pensions, James and Amy, who you've already heard from, but also Joe Stacey. We have Vanessa and Simon from the Financial Reporting Council. We also have Gary Miller, who is on part of the Pensions Dashboard Programme, and Lucy Stone from the Pensions Regulator. So, unsurprisingly, a lot of the questions were around the sort of the main focus here, which is on values, and I will spend most of the time focusing on those. There were a couple early ones on some of the more general stuff around pensions dashboards, so I might just quickly deal with a couple of those. And then we will perhaps move on primarily to the value questions. So first of those I'm going to pick up is about qualifying pensions dashboard and whether there is a body to cover certification to be a qualifying pensions dashboard. Now, I know, obviously, we don't have anybody from the Financial Conduct Authority on our panel today, although they obviously have a role to play in all of this. But James, I don't know if you wanted to come in on that question.
Yeah, absolutely. So the criteria to become a qualifying pensions dashboard service and thereby deliver a dashboard are set out in the consultation and in the draft regulations. And I think the core expectation or requirement is that they comply with standards set out by the Money and Pension Service. As well as that, they must be and become FCA authorised and obtain permission to undertake the new regulated activity of operating a qualifying pensions dashboard. So they're the two sort of central elements that dashboard providers will need to satisfy. We've also proposed in the consultation a sort of third-party audit approach. That third party would be responsible for assuring the provider that they were compliant with all the standards, particularly things like design standards, and that should be ahead of connection as well as on a sort of an ongoing basis. And that's something we're really keen to get some views on from consultees about that and who might fulfil those sorts of functions.
Right, thank you, James. Next question kind of refers to, I guess, the scope of dashboards. Is there a plan to include pensioner members in the longer term, and what is the expected time frame for that? Amy, I'm not sure if you'd like to come in on this one.
Thank you, Simon. Yes, as I mentioned during the introductory section, we're not including pensioner members in this initial set of regulations, as our priority for initial dashboards is to provide information on pensions while still in the accumulation phase. And whilst we don't currently have plans to include pensioner members, we are not ruling out that they may be included in the future, but there are no current plans at the moment.
Thank you, Amy. And we'll do one more of these sort of general questions, and I'm going to move on to the value ones. So the last one I'm going to ask is about staging. Is it right that individual groups / sections of industry-wide sectionalized schemes will be treated as separate schemes for staging purposes, given that's how they operate on a day-to-day basis? Joe, would you like to come in on this one?
Yeah, and I mean, it may depend on different people meaning different things about sections and schemes and things, but the regulations apply at a scheme, not a section level. But it is possible that schemes may connect early to the dashboard with the agreement with maps, if that is beneficial from an operational point of view for both the administrator and the programme and the regulator.
Right, thanks very much, Joe. I'm going to move us on now to some of the stuff around the many questions we've had around values. So just to start us off on there with a question about how the values will be presented, and I guess what some of the rules around that will be. So will schemes providing values be able to add their own caveat wording on top of the dashboard's caveat wording? Gary, I don't know if you'd like to come in on that one.
Yeah, I thought that one was going to come to me. So thanks, Simon. One of the things that we're looking at the moment are the warnings, explanations that dashboards have to give to users as well. So that's very much something we're focused on. We're going to mandate those in our design standards, which apply to dashboards, to explain the illustrative nature of the forecasts that are provided. So caveats will be given, but also under our data standards, one of the proposals is for some free text as well. So if the scheme wants to provide a short message back to their member, then they will have that sort of opportunity to do so as well as the existing caveats that dashboards must provide as well. So hopefully that gives a degree of comfort that caveats will be included, but also there will be a function to communicate directly with your member with a short message.
Right, thanks very much, Gary. I might stick with you if I may, because we've had a number of questions around user testing, which obviously was kind of mentioned a bit in the presentation. I think probably it'd be worth maybe just outlining a little bit of kind of what has been done in terms of the user testing. So some of the questions we've had are in particular around kind of age. So is the PDP research forward-looking only, i.e. a person who hasn't retired yet? Consumer testing looking back after retirement is crucial too. And this has also come up, who will members blame if they made decisions without IFA advice and things turn out different from the dashboard? So a little bit of a kind of what happens to consumers, after they've made decisions, they've used their dashboard, they may not get what they wanted or they imagined. Gary, would you like to just sort of say what we've done in terms of user testing?
Yeah, so as I mentioned, through the minimum design standards, what we're hoping to do, but actually what's gone into that, and actually, and also your regs have relied upon that has been extensive sort of user testing over the last year, with different prototypes, and it's been really interesting sitting in the lab with people, and sort of watching its reactions to this, as well as more broader qualitative user testing, as well as based on international experience and other findings as well. So we've pulled all of that together, and that's ongoing, by the way. That doesn't stop. And why we're doing all of that is very much consumer protection focused in mind, so that whenever individuals do see these values, well, actually the contextualization, the help to be able to interpret them, what they should do next, or what they should consider doing, for instance, going to maps to get some guidance, etc. All of those are things that are in our mind. So we reduce down the possibility of users acting in an uninformed manner. after that. So yeah, and I think one of the other parts of that question was what age groups or demographics have we been used testing? We've used, the entire range. We actually have been speaking to people who are sort of post-retirement as well, exactly for the point that was sort of raised in the question. Somebody who's gone through the accumulation phase and then decumulation phase to give us insights into both as well. So it's been a range of demographics, range of people in different sort of situations, accumulation, deferred pensioners as well, just to give us that sort of complete rounded picture.
Thank you very much, Gary.
Thanks.
I'll bring us on now to some of the questions around the find and view data. And we'll start off with a question around projections and consistency. So the question is, projections may differ in different schemes, as some will include estimated increases, others will not, and will simply project forward based on current values. How are you going to be able to ensure consistency and be able to provide an explanation of what the illustration or projection means? James, I don't know if you'd like to come in on that one.
Yeah, so I mean, I think the way we've set out our regulations, as well as the reference to ASTM1 for the applicable pension scheme types, is intended really to try and ensure a degree of consistency, so that schemes do provide values which can be read alongside each other. We're obviously keen to understand, I think, as I said earlier in the presentation, we're keen to understand the extent to which the regulations are drafted in such a way as to allow schemes to provide the values they would sort of expect to provide on the basis they expect to, that is reasonable and relevant, but also ensures that there is consistency across the different within rather schemes and across schemes. So really important, really keen to understand that and get some feedback on that, because there are clearly lots of different complexities in terms of providing these sorts of valuations or values. In terms of the sort of explanation of what the illustration of values means, I mean, I think Gary's probably set out that in reasonable detail. So design standards in particular will be really important in ensuring the values are presented with the appropriate caveats, with the appropriate explanations, and possibly with some messaging as well from the scheme itself. So we're looking into that. And of course, data standards provides the some of the opportunity to provide some of the specific administrative data and other data around to sort of contextualize those values. So I think, yeah, I mean, I think as I say, the regulations are intended to try and move towards a reasonably consistent approach, and we're keen to sort of find out the extent to which that's been achieved.
Thanks very much, James. I might stick with you if you don't mind. We've got some slightly more detailed questions. We've got one here around admin data. So why can admin data be delayed by 3 months, but there is no corresponding regulation with regard to signposting and value data?
Yeah, you're right. So it's a good spot, and something we will be attending to in the revision of these regulations. Our policy expectation, or our policy thinking at the moment, is to mirror the administrative data expectations for value data. But we are keen to hear views on whether that is sort of doable. So please do respond on that.
Absolutely. Thanks, James. And then another one we've got here about schemes. Some schemes also have automatic lump sums along with annual pension. Will the dashboard be able to cope with this?
Yes, so it will do in two ways. So firstly, the regulations do set out that that providers can provide, schemes can provide both an income or a lump sum, or both where relevant. Again, I'll just reiterate that those lump sums aren't commuted lump sums. They are values. They are specific pot values as part of the benefit. So yes is the answer, and I think data standards will allow us to sort of specifically link those and make it known that they are part of the same benefit. Gary, you should come on mute.
Yeah, that's entirely right, James. Because we do recognise the fact that, and it's mainly DB schemes do a number do provide not just an income upon retirement, but a lump sum, which you quite rightly said is different to the commutation. So we've followed suit with the data standards on that basis to allow that to be presented on the dashboard.
Thanks very much, both. One more question around administration data. So does administration data include employment information? This data might not be readily available. Who'd like to come in on that one?
Would you like me to pick that one up?
Sure, please do.
Yeah. So the answer is, if it's available, provide it. If it's not, you don't have to provide it. So recognize, the fact that whenever it comes to this level of data, not all schemes will have it. So there's a degree of sort of flexibility depending on the scheme's position. I think that's right, James. Is that? Yeah.
Great, thank you both. We're going to do a couple more questions on the sort of presentation and explanation, I suppose, of values on the dashboard. So the first one here is, was a monthly rather than an annual value considered at all? It may make more sense for a lot of members, particularly those in workplace pension schemes, as it aligns to salary. Any views on that one? Gary?
Yeah. So I'll lump this in. There's another question about sort of graphical illustration as well. So I'll deal with both together. It's very much something that we are looking at. So even though for simplicity, we're requiring schemes to provide sort of the proposals as annual figures, that doesn't necessarily mean that things have to be presented as annual figures if the user would prefer a monthly figure or weekly. And those are things that we're looking at in the design standards to allow the best presentation of the data that's sent through to the user. And that could well be over a certain time period or in a graphical way. And we don't think that's any sort of manipulation of the data. That's just presentation in a sort of better user format. So those are things that we're absolutely looking at, because we want to make it more easy for users to be able to ingest and understand. So yeah, that's very much something that we're looking at.
Thanks, Gary. I'm going to do one more in this sort of theme where I suspect design standards might well also be part of the answer. How will annualized, accrued, and projected values be explained on dashboards? The items have fundamentally different implications to DB and DC. How can we ensure users will not conflate the concepts? Gary, do you want to come in on that one as well?
That's going to be the rub for design standard, and that's very much something in the forefront of our minds about doing that. Explaining the basic. Well, I think you have to explain the basic concepts, but then you also have to explain the differences as well whenever you present, especially because you're presenting all this information together. So those are challenges that we're trying to wrestle with at the moment. And whenever we put out our design standards for consultation sort of later on in the year, the industry will be able to tell us whether or not they think we've done a sort of good enough job. And by the way, whenever we put them out, we're going to involve these as well. So none of the standards are going to be static. So we have to learn from ongoing user experience and sort of improve them as well. So watch this space for over the summer and people can get back to us.
Thanks, Gary. I'm going to just keep a little bit with the kind of annualized accrued value. It's got a specific question here. So the annualized accrued value is new for money purchase. If, say, a member is 25 and have an accrued pot value or current pot value, are you expecting us to show the annuity they could buy now with that pot value? For young members, that is going to be extremely misleading, as they can't get their pension until age 57 based on the new normal minimum pension age. Who'd like to come in on that one?
Shall I
James?
come in on that? Yeah, I'll come in on that. So I mean, yeah, we do expect that that value should be shown and provided. We think it's really important to be able to provide people with a feel in sort of income terms of what pension they're going to get. I think we know that that's income is something that people can understand. Pot is possibly more difficult. I accept that it's it's a long way away. So there's a bit of sort of gymnastics to think about around that, but it is not dissimilar to think about this in the same way as, or arguably in the same way as, accrued DB pots, or indeed for state pension inside projections. Just to sort of clarify, it's the expectation is that you think about this annuity as if you are at your retirement age now. So it's not that you're buying a annuity that's going to last you for 80 years or something. It's a sort of a sort of more normal pension annuity. So hopefully that provides a little bit of clarity.
Thanks, James. I'm going to move us on to a few questions specifically around defined benefit pensions. So we've had quite a few about that. So the first one I've got here, I've been told that for deferred DB members, the projected values do not apply. Is that correct? And how does that meet the objectives of the dashboards for individuals to be able to understand their likely income in retirement? So deferred DB, James.
Yes, I say that. So yeah, we are proposing an accrued value only, and I think when I first started conceptualizing deferred DB pensions, actually accrued and projected quite often will look very similar, because you're not continuing to accrue into that. So there's an argument to which says you sort of just don't need two sets of values, which may be reasonably similar depending on obviously the methodology you use. So we've picked the accrued value rather than trying to construct a projected value, partly for simplicity, partly because we understand that that's what's most likely provided. So it's a valued to the illustration date. Now, there's lots and lots of ways I think of providing that, and I suspect people have lots of views about how to do it. We're really keen to understand what they are. We've put in there a sort of a simplified alternative, which is possibly easier. I think has some issues as well. We're keen to understand views on that as well. So, but yeah, so we do think it's an important value, and I think it does to an extent, or I think it does help meet those sort of dashboard objectives of understanding what your retirement may look like.
Thank you, James. We've had quite a few questions which relate to kind of particularly DB schemes where I think in a number of cases public sector schemes have been specifically mentioned, where there are kind of different benefits payable at different ages. So I'm gonna pick one of those out, but I think it'd be good to get kind of a view on the sort of the general point. So this one is, how will tranche DB benefits with different normal pension age be displayed, both for accrued and projected values? What choice, if any, will schemes have over this? Gary, would you like to comment on this one? Or
yeah, so schemes will have a lot of choice here, how they calculate the value of the benefit at a single date. So that hasn't been, that discretion hasn't been removed from schemes as well. So that's, and what they produce representing, what they think is the best way to describe that value at the date that has been chosen is what is returned there. So and that's one of the reasons for leaving the discretion schemes, especially for DB schemes here. Recognizing the difference or complexities, and that schemes will have, a lot of schemes will have wrestled with this problem, come up with their own answers as well. And I mentioned earlier about the free text box, and the free text box, gives the scheme the opportunity to provide a degree of sort of explanation as well about that, a bit more information. So I think as one of the questioners sort of outlined, how do we square the circle between simplified presentation and sort of the complexity of pensions? Well, by hopefully not in DB arena, removing the scheme's ability to come up with the best answer given their experience dealing with their membership and their understanding of their benefit structure.
Is it worth just adding that we're really keen to understand what schemes do now? This is not necessarily entirely new. Obviously it's new to send them to dashboards, but I'm presuming schemes have to sort of deal with this question reasonably frequently. So it'd be really interesting to hear how schemes are actually managing this, given that disclosure regulations provide an element of leeway as well.
Thanks very much to you both. I'm going to bring us on now to some questions around ASTM1, so our colleagues from the Financial Reporting Council don't feel left out of the party. So the first one I've got here, if we produce benefit statements at 31st March 2023 on the existing ASTM1, can we use those figures for dashboards from 1st of October 2023 until 31st of March 24, if we're all following that? Or will we need to rerun benefit statements at October 2023 using the new ASTM1? So I think there's a question there about kind of what is required by when in regards to new ASTM1 assumptions. I don't know whether Vanessa or Simon would like to come at that one, or actually whether James, you want to from the sort of regulatory perspective.
I'm happy to set out my expectations, and others can chip in. And my expectation is that the benefit statements produced at 31st March 2023 will continue to exist, obviously, and won't be shown on the dashboard when that comes live in October 2023, until the benefit statement is then updated in 31st March 2024, and at that time that will come on live on the dashboard. But yes, others can supplement if that's not the correct answer.
Anyone else want to come in on that at all?
So
go on.
So I think I'd sort of characterize it as yes, statements will sort of roll through. There's no mandation to show to provide a value to dashboards until a statement has been provided after October 2023. So that might be that you do it in November 2023, and that's when you'd be required to provide those values to dashboards. If you do want to show something before that, then you may do. And you should do it on the basis of the methodology that's correct at the time. I'm not sure if that's different to what you said, Vanessa. The same.
Thanks. I think that's a helpful addition. So I think we've got a question here, which I think relates to some of the assumptions in the revised ASTM1. So why will it be mandatory to not assume a tax-free cash lump sum for DC schemes? Most people are entitled to 25% and protected tax-free cash is not very common. It's going to mislead customers as to their estimated retirement income because nearly everyone takes the tax-free cash lump sum and their actual retirement income will be lower. Simon or Vanessa, would you like to pick that one up?
Yeah, okay, I'll comment on that. I mean, previously in ASTM1, we did give the flexibility to show tax-free cash. And we put in a caveat: if it's more than 25%, it's got to be a good reason, etc. The issue is twofold. First is that we were very keen that what is shown in the annual, remember that ASTM1 applies to the annual statement, and not to anything else, the annual statement. Very keen that that would dovetail with and be the same as what is shown on the dashboard. So given the dashboard architecture, that led us down the route of not showing a lump sum. That doesn't take away from people the ability to go to their providers individually and find out how much cash is available to them. And it's the sort of thing that's only really relevant when they get closer to retirement. Because when you're further away from retirement, you're really interested in what the overall size of the value you're going to get out is, rather than how you're going to split it into cash and an income. And the other technical matter is that when you start putting pensions all the plans next to each other, you have to be very careful about the tax status overall and the limits on the tax-free cash sum. And therefore, it's not a straightforward matter to make sure that what's being projected actually is going to be a fair reflection and accurate, and not be overstating the fact, because individually the providers won't be aware of the tax situation, but you put everything together and you may start breaching tax rules. So, it is a difficult call, and we're certainly not trying to stop people taking lump sums. And for those people close to retirement, then it comes back again to the fact that they shouldn't rely just on what they see from automatic processes like a dashboard or an annual statement. They really should be looking at it more closely, and where appropriate, they should be taking advice from experts.
Thank you, Simon. I'm gonna do one more question, I think, on ASTM1. So, was consideration given to using annuity values based on a long-term annuity rate rather than continuing to use a current gilt-based approach, reflecting current estimated pricing? Will any sensitivities be shown, or will members just see one number? This will not help members to understand that there is more risk involved in pursuing more. Sort of lost the end of the sentence there, but Simon, or Vanessa, I'm not sure if you can look at the take on the question about annuity rates. Simon, I think you're on mute.
Yes. Well, let me come in, and then Vanessa can come in and correct me when I get things wrong. Did we look at long-term annuity rates? Yeah, we spent a long time discussing how we should frame the annuity rates. Originally, I was in favour of long-term standard annuity rates that didn't change until you got very close to retirement. That would have made the structure more complex for providers. And also, it doesn't really help at the end of the day, because if you take assets at market value and far away from retirement, people will be tending or should be investing in more volatile assets. They're going to go up and down in value. And one of the advantages of having a system that looks at interest rates that you can measure now is that they should also bear some relationship to the ups and downs of the market. So there's a sort of setting off effect between the two of them that helps stability. So it was a long, complex conversation that we had internally before staying with what we had. We looked at the possibility of tiering it so that more than 5 years out from retirement, we'd have this standardized value. And then between 5 and 2 years, we'd do something else. And then 2 years, we'd have current annuity rates. At the end of the day, what we came down to is the fact that illustrations are just that, illustrations. And there is no point putting in spurious scientific accuracy to the extent that it makes life difficult for everyone and introduces discontinuities, etc., more than is necessary. So there's a value in simplicity on all sides of the fence, as well as trying to get something which is, in inverted commas, right.
Right.
Now, the other part of the question was to do with uncertainty. And uncertainty really comes into two components. And these are difficult issues. And they are such difficult issues that it wasn't really feasible to solve them short term and still land something that was meaningful. Doesn't mean the issues have gone away, but the issues are in the difficult box. And those two issues are, how do you get people to understand that when you provide an illustration for them in 25 years' time, that illustration doesn't represent anything guaranteed, and they shouldn't take it to be guaranteed. There is a whole range of probable outcomes, and even those probable outcomes are not the limit of what could happen. So how do you get people to understand that and still to manage that in a meaningful way and not just become paralyzed as a result, but actually empower them to know what to do with that information? And that is something I think that still needs to be thought about and addressed, not just within this projection system, but within education and national consciousness, to get people to understand the difference between showing them what we project will happen and showing them the degree of uncertainty in our projections. Because at the end of the day, models are just that, they're just models, they're nothing more than that.
Thank you, Simon.
And the other thing is,
sorry, Simon, I think I'm going to have to interrupt you. Okay. I'm afraid we are out of time. We can kind of pick up any more detail on that point in the Q&A, the frequently asked question document that we will put together. But thank you very much for your answer, and thank you to all of our presenters and panelists today. We really appreciate your contributions and involvement, and a big thank you to all of our attendees. I hope you have found it a useful session today. Particular congratulations with respect to anybody who's managed to survive all 4 of these webinars, and I do hope that they have been a really helpful opportunity to engage in some of the issues and questions that the dashboards, regulations and consultation have thrown up. I would like to, as well as thanking you all for attending and contributing, really like to reiterate our plea for you to respond to the consultation. It closes, I think, on the 13th of March. We will then be taking forward the work following that to look at the regulations before we present them to Parliament and publish our response to the consultation. I think that's probably all I have to say. The recording, the slides, the FAQ will go onto the Pensions Dashboard Programme website. So please do have a look at that. I think that's probably it for our series of dashboard webinars. I hope you have a good rest of your Thursday and a good weekend when it comes. Thank you very much again for attending, and goodbye.